I hope this 4 sessions gave you a really quick pick to what we're doing later. Also at Stanford, you get to see what your investment thesis is, the deal flow, picking the companies, and then exiting. And what we're going to do is to do a quick transition to, we're Skyping Mark Suster in. Mark Suster is 2 times entrepreneur, sold it twice to Salesforce. He writes a really prominent blog, both sides of the table, and he actually is giving, it was a surprise talk, but actually we're all really excited. It's going to be about the venture outlook for 2015, so pretty much if we are in the gold rush or not. Hey Mark, the stage is for you.
Okay, so is there a way to change the screen so I can actually see the audience, or that doesn't work? Doesn't work? Okay.
There's no audience.
People out there rather than one individual with expectations. Okay. And did people have the opportunity to download the presentation so when I scroll through the slides, you'll actually be able to see them?
So everyone, can you please, so the on SlideShare 500 Startups, you can find Mark's presentation. So.
Okay. I want to say also, if anybody has a mobile phone, or particularly an iOS phone, we are mirrorcasting this now, so you can actually see the behind the scenes if you want. On Mirrorcast, you just need to go to Mirrorcast and M-Suster, M-S-U-S-T-E-R, and you'll see it live. So the topic for today for me is Venture Outlook 2015. Is it gold rush or is it fool's gold? And what I mean by that is we're living in a time of almost, yeah, go on. Oh, sorry. We're living in a time of almost unprecedented funding. We've seen this before. We saw it in the late 1990s. But the amount of money that's now available for early stage startups is reminiscent of the late 90s. The amount of money and the valuations of late stage pre-IPO stuff is almost unprecedented. And so is it because we are on the verge of a total transformation of all industry, or have we just had market amnesia and return back to the late 90s. So on the first slide, what I like to talk about is in the era of Internet 1.0, we had about 50 million users online globally. It was a very small community. And on the chart, what I show is the ascendancy of the global internet. We're now north of 2.5 billion people online. That's about 70% of the world's literate population. On slide 3, which is topic 2, you'll see that online speeds are now about 180 times faster. 180 times faster. So we were on 56K modems. We're now on average 10.5 meg in the United States. So that is going to feed into my narrative. If you look at the next slide, we are all on smartphones now, particularly in the United States and Western Europe, but this is the massive trend in India. We have about 40 million smartphone users now, and they're expecting that over the next several years to go to 400 million. 40 million to 400 million. And those 400 million people were never really properly connected to the internet because the wired internet was almost non-existent in India. And that is somewhat a time of unprecedented change and opportunity. So it's no surprise that we're seeing a lot of funding right now going into India. The interesting thing to me about mobile is not that just that we have powerful computers in our pockets, not just that they're connected at increasingly fast speeds, but also they are very personal to you. It's something that you're more likely to go home if you forget than going home for your wallet. And it's location aware. It knows where you are as you move around. I like to call it point of purchase. So if I'm on my computer, if I'm at home and I'm searching for movies or restaurant, I'm showing the top end of the funnel of intent. If I have my mobile phone out and you know that I'm right next to a movie theater or right next to restaurants, or you know that I'm in Austin, Texas, but I'm normally in LA, you're at the bottom end of the funnel. And actually what it turns out is, on the internet with a wide screen, if I give you a lot of choice, a lot of merchandising, people have enjoyed that historically. What most great vendors are doing is reducing their choice on mobile devices, given the smaller screens, and reducing it is actually driving up conversion rates even higher than they were on the web. So mobile turns out to be a pretty big trend. The thing that I think we all know intuitively is that we're socially connected. What's important about being socially connected? Well, when ideas work, they spread faster than at any time in human history. I'll give you a couple examples. Everyone in the tech community, and now it's spilling over into broader media, is talking about Meerkat. Meerkat has been live for about 3 weeks, and my phone is lighting up like a Christmas tree with constant Meerkasts. Now, will it last? I don't know. But this kind of social diffusion, I just wanted to point out, because a lot of you are probably starting to see it, is a consequence of socially connected networks. We funded a games company. That games company didn't have a product until October of last year. They launched in October. In 6 months' time, they've driven about 7 million downloads, about 1.2 daily actives. They will cross, for sure, 35, 40 million in revenue in 2015. That's their first year of sales. When in human history was that possible? So it is classic innovator's dilemma, where we are massively reducing the cost. You pay 99 cents to engage with an app versus $25 to go buy something, and then a $400 PlayStation or Xbox. 99 cents, but a 2.5 billion person audience. The thing that I think is most often overlooked is the next slide, point number 5. And that is that we are all credit card enabled. It's a single click to interact with anything these days. What's important about that? When we launched e-commerce companies back in the late 90s to 2005, the number of people who didn't want to register their credit card because they didn't trust putting their credit card online, or they just fell out of the funnel just because it was 3 extra steps. People feel that friction was enormous. Now it's single click purchase. And the Apple ecosystem itself went from 0 in 2008 to 35 billion in 2014. Now I want to point out what that means for Apple. What that means for Apple on a 30% rate is about $10 billion in almost pure profit. Again, innovator's dilemma, enormous audience, very cheap price, socially connected, it scales very fast, and single click to buy, and that has driven a lot of purchasing. So the other thing I like to point out is about the venture capital industry itself. You'll have to excuse me 1 second. Sorry, my screen just got whacked. The venture capital industry itself, what happened between 1997 and 2000, is we had a tripling of the number of VCs that existed. And we had a tripling of the total amount of LP money going into the venture capital industry. And if you're going to triple an industry in terms of number of players and capital in just 3 years, you're bound to have a tremendous number of problems because you have a lot of inexperienced people and inexperienced capital making investments. But what I'd like to point out on slide 6, if you can see it, is between 2000 and 2012, the industry completely right-sized. $50 billion going into venture capital firms in 2000 went all the way down to about $16 billion in 2012. Now that's trending back up towards $30 billion. That is just money going into the tech investors within venture capital. That excludes life sciences. So we've had a return to the norm, and yet it's trending back up. So, in some ways that worries me. So if you think about it, next slide, 50 times the users, 180 times the bandwidth, 6 times the amount of time spent online. We're now spending 3.1 hours per day online. Everyone's mobile, everyone's social, everyone's credit card enabled, and we still have this global economic pressure that hasn't relieved itself since 2009, and that is also a lubricant for innovation and disruption. So companies that work are growing faster than at any time in human history. What does that mean? That means when companies do IPO, and on the left-hand side of the slide I've got Cisco, Amazon, Microsoft, and their market caps, which were all under $1 billion. On the right-hand side, I have a slide that's actually incorrect because I sent over an old version of the deck, but I'll give you the real numbers.
Twitter was about 18 billion when it IPO'd. Facebook was about 108 billion when it IPO'd, and Alibaba was about 230 billion when it IPO'd. So what happens when a company gets to 100 billion or 200 billion before it IPOs? It means value was captured in the private market significantly more than in the public market, and I'm going to come back to that. If you look at the next slide, the median amount of time raised, amount of capital raised prior to an IPO has steadily trended up. It doubled between 08 to 2013, but that's probably doubled again by 2015 because of the immense amount of money going into late stage investing. If you look at the next slide, I like to point out though, this is not 1999 and 2000. In 99, 2000, the mean time to an IPO was 3.1 years. In 2013, it was 7.5 years, and it's actually getting longer, not shorter. If you look at the revenue multiples, the valuation over revenue, we're in significantly better shape now because companies actually have robust revenue. And the revenue itself is something like 3 times bigger at the time of IPO. Now, on average, companies have about $100 million in sales before they can actually IPO. So we have healthier companies IPOing. But this is, right, for me, the money slide. And what I mean by this slide, if you look at the left-hand side, if you can see the slide, we have traditional VCs that made investments that in the past would IPO. When companies IPO'd, most VC firms exited. That's the time that their LP said, give me my money back. But if we're doubling the amount of time they're in private markets, and if the value capture happens in private markets, what do? Do they just say someone else take that value? So what they're doing is they're raising what's called opportunity funds. They're pooling their LP money into a vehicle, sometimes called an SPV, special purpose vehicle, and they're following their pro ratas. As they follow their pro ratas, that means there's less available to new investors. If you look at the bottom, we have the entrance of new corporate VCs, so Google, Rakuten, Alibaba, all these people entering the investment market. Now, the important thing about this is half the time not half the time, probably more than half the time, they're interested in more than just financial return. They don't want to lose money, but they're really trying to get access to innovation. And if you're partially about access to innovation and you're competing against someone who's purely focused on economic results, guess which of those is going to pay a higher price? So prices are being driven up. And on the right-hand side of the slide, you'll actually see traditional public market investors, people like Fidelity, on the mutual fund side and the hedge fund side that are trying to get pre-IPO positions and investments. Now, as those prices are going up, even of pre-IPO firms where Uber is raising at a $40 billion valuation, they're being forced to go earlier and earlier. So if you look at the next slide shows you the valuation change between 2009 and 2014. The blue line, 2010, the blue line is 2014. The gray line is 2010, and what that is it shows on the bottom chart seed A, B, C, and D. And what I'd like to point out is Series D has grown on a CAGR, compounded annual growth rate, of about 25% per year. And that is actually, again, increasing, not decreasing. So valuations are up across the board, but they're most up at that Series D because when things work, everybody piles on and competes. So on the next slide, you'll see that it's now fueling this discussion about a bubble. But the reality is that both trends are real. The value that's being created is real. The revenue growth is real. Some amount of the revenue growth is fueled by all the venture capital that goes into the ecosystem, because that venture capital gets spent on advertising and customer acquisition. And so some of the amount is just internal money swirling around. And when the market corrects, some of that money is going to pull out of the market. But a lot of that spend is real, and a lot of the disruption is real. And yet people are forward paying for valuation. There is no rational multiple that can be given for the prices that people are paying: $1 billion, $2 billion, $5 billion, $10 billion, $20 billion for Snapchat, 15 to $20 billion for Snapchat. I think it's an amazing company. I'm long Snapchat, but what people are saying is I believe that for the next 10 or 12 or 15 years, that company is going to grow to a point that will justify me essentially overpaying on financial metrics today. So my final slide is basically dissecting a few of the topics we all face. One is crowdfunding. So I want to delineate crowdfunding, which is a topic I'm often asked about, between equity and pre-product sales. We are very big fans of pre-product sale crowdfunding. My message for anyone who wants to look at that market is narrow the amount of time before you actually do a crowdfunding campaign. You should be able to ship your product in about 4 months if you're going to go to crowdfunding. If you end up in the 6, 12, 18-month category, you run the risk of diluting your brand because customers get frustrated without being able to see your product. On the equity side of crowdfunding, I also believe there's some amount of goodness in the equity funding because you're widening the scope of the number of people who can get funded in the first place, and not everyone can easily access venture capital. The warning note I have is the people putting money into those platforms have very limited visibility to the capital structures of the companies they're funding and have almost no, maybe even zero visibility in the financial performance of those companies. So companies that, over time, if you are a normal VC investor, you're getting financial reports, you're getting updates, the management team, you're tracking things. Often on these crowdfunding platforms, you have no visibility. And in the secondary market where I'm funding an Uber, a Snapchat, a House, any of these companies in secondary markets, in effect, you're paying public equity prices without public equity oversight, which means that you have absolutely no transparency about their financial performance, how the companies run, what directors are doing, are directors selling, so on and so forth. So I feel some amount of dis-ease with part of the equity crowdfunding market because I believe we're going to burn a whole bunch of investors. By the way, this is, of course, Groundhog Day because this happened in the 90s with the Neumarkt in Germany, the Nouveau Marché in France, the AIM market in England. They all lowered the amount of oversight into companies, and a whole generation of retail investors that were inexperienced got burned and lost money. Angels. The thing I would point out for angels is just be careful if you're early in the cap table, being in one of these companies that has immense amount of capital going into the company at huge valuations. First of all, that doesn't necessarily equate to a return for you because those valuations don't mean necessarily that that company is going to be successful. What's good for angels is these secondary markets means angels can get returns early. If I were an angel in one of these hugely valued companies, I'd be looking at taking some heat off the table. In venture capital, my biggest cautionary note for VCs is in this late stage market where valuations are insanely overvalued, and just be careful about not getting over your skis. And I also am not a big believer in what I call the markup game, which is early stage VCs trying to get their companies to raise huge amounts of money at artificial prices because what you in a sense have is an entire market that probably can't go public anytime soon. They can't go public because the valuation they've said probably wouldn't hold up to public market scrutiny and valuations today. And so I have a lot of discomfort with what's going on and the prices being paid in the late stage. And for founders, my advice is I really believe still firmly focus more on the quality of your investors than absolute valuation. People always say that's convenient because you're a VC and you just want cheaper prices. I'm not going to fund 99.999% of the people I'm giving the advice to. I believe that we go through good markets and bad, and the most important thing as a founder is to have someone who's going to help you navigate through good markets and bad, and your good performance and bad, because everyone stumbles. And over-capitalizing and setting your price artificially too high really catches a lot of people out when the market corrects, and a lot of great companies never get through down cycles. So really, that's all I have. I don't want to overstay my welcome here. I'm happy if Dave or anyone wants to ask questions. I'm also perfectly happy to just shut up.
Sorry. Try to take some questions from here.
Does Dave have shoes on or does he have sandals on?
Sandals and a jacket.
Don't you think that Dave should change his name to Jesus? Or we could, I know, you know what it is, like he's in Miami. I should call him Jesus.
I'll take Meerkat questions after the audience.
Actually, okay, so I'll ask a question while the audience is thinking. So, Mark, you're doing a lot of promotion for Meerkat. Are you in the round?
I am not an investor in Meerkat. I would
Yes.
gladly become an investor in Meerkat if I was offered the opportunity. If anyone who happens to work for Meerkat is watching, I'll happily invest in your company. Look, so people ask me this question all the time, Dave. Let me tell you this. I'm a big believer in being early in networks. You and I both were very early in Twitter. I was never an investor in Twitter. I was never in Twitter's suggested user list. So every one of the 200,000 followers I have, I earned the hard way by engaging, by promoting content, by being active, by being present. And there's value accrued from those relationships. I was early in Quora. I was writing Quora answers. I have 25,000 followers on Quora. And if I want to get, what is it that I'm interested in? I'm interested in share of mind. The more I can get in people's minds and try to either persuade them to think how I think on a topic, if that benefits me, or if I'm wrong and I get feedback, that's great too. So a lot of times people will call bullshit on me. And so I feel like Meerkat has captured a zeitgeist that hasn't existed before, which is this intimate, real-time, FaceTime kind of interaction. And if I can be early and gather an audience, and if that market succeeds, I think it's great. That's why I'm doing it.
I'll ask you one thing that's maybe local to the LA area, a la Peter Thiel. What does LA believe that the rest of the world does not?
LA believes, as I think most Miamians believe, that the sun is a direct contributor to quality of life. So I should tell you that I lived in Miami. I lived in Miami in 1992. I would say the 6 months I lived in Miami were amongst the best 6 months of my life. My colleague Stuart, who's mirrorcasting me right now, also lived in Miami. How long were you in Miami? About 3 years?
3 years.
3 years. We're both very big fans of Miami. The difference between Miami and LA is we don't have the humidity.
Yeah.
So I'm a big believer in sun as a quality of life measure, and humidity sucks. And yeah, and there's no rain here, but that's going to be a downside in 50 years. What else you got?
So maybe last question. I know we've talked a lot about investing internationally, and I've gone a little bit long on that strategy. You're big on video. What's your thoughts on investing in video startups that are outside the U.S. market? And would you consider doing that, particularly, let's say, the Spanish-speaking market?
I almost feel like I teed this question up for you in advance because this is exactly what I want to talk about. So many people know I'm what's called a Jutino. My father's from Colombia. He's from Medellin. And so I grew up very much with Latino culture. All of my cousins, part of the reason I enjoyed Miami so much is a lot of my family lives in Miami. So they're all bilingual, part Cuban, part Colombian, many family members in Dallas, Texas. And so I've always been immersed in that culture. If you look at, I made an investment in a company called Maker Studios. We sold it to Disney for about $1 billion. We were the first money in and the largest shareholder. And more than 70% of our audience was outside the United States. This goes back to my theme of global markets. In a world in which we have global markets, in a world where you have limited distribution, someone who creates a Latino program in Venezuela or in Chile can't get that seen in the US because the distribution networks are closed. But in the current world, you don't have distribution barriers. So the Streamies is an award that we have here in Hollywood, and the best audience award choice at the Streamies in Hollywood was in Chupe, which is a comedy troupe out of Chile. And so the next company I funded after Maker Studios is a company called Me Too Network, MITU. which is a Latino MCN. It's the fastest growing online video platform for Latinos. And we're promoting talent in Colombia, in Mexico, in Chile, in Ecuador, and bringing them to the United States and giving them opportunities in the United States, but also building their local markets and local audiences. These markets are global, and it's what I call torso TV, which is this. You have the head end of TV, which is the super expensive, highly produced shows that are going to be controlled. And then you have long tail, which is all the little stuff that very few people watch, and both of those are hard to monetize. The head end is monetized by people who have the most amount of money, which is the studios, and the long tail is only monetized by the platforms like YouTube. But the torso, you can produce shows like Bollywood shows or anime or South Korean drama. And it turns out that there are global audiences of people who are interested in those micro genre, and those micro audiences are 50, 100 million big. So I'm a huge believer in globalization. We ourselves will invest in global businesses. We have one reason for liking domicility to happen in the United States. We understand the tax consequences, we understand the legislative consequences, we understand the HR consequences, the exit scenarios. So if you look at Me Too, we're investing heavily in Mexico and Colombia, but the top co and the top management team is based in LA.
Thanks, Mark. Really big fan and glad you could meercast to us here in Miami Beach. And hope to see you either in LA or San Francisco sometime soon. By the way, I think you should go with Juice-Spanic, not Jutino, but...
But I do want to say a huge thank you to you, Dave, because opening up the mind of the world to both startup opportunities in LATAM and on a global basis, and investors in LATAM on a global basis, it's important work. And I think Silicon Valley can often get too focused on 5 miles around themselves, and there's innovation happening all over the world. I've lived in 6 countries. I lived abroad for 11 years in Asia and Europe, and I just think you're doing great work, so thank you.
Cool. Well, we hope to do some international syndicates and maybe work with you on a couple of those coming up soon. All right. Thanks, Mark.